Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout this show. Well, the stock market continued its upward march last week as the NASDAQ finally did edge out an all-time high on Thursday following the Russell, which has continued to make new highs. Thursday did bring a reversal in the FANG stocks. They finally got heavy as they have been soaring to the upside. And then some news came out on Friday that had Apple moving to the downside on some softer iPhone sales. So that weighed on stocks a little bit, but it really has not been stopping the stock market from continuing to move up. Also not getting in the way, other than for more than seemingly moments overnight, are the war of words as President Donald Trump comes out and really takes a hard line with our allies, and Canadian leader Kudlow and France leader Macron come and hit back hard, saying that they are going to retaliate and even are threatening, besides strong retaliation, that the G7 may actually become the G6 as they threaten that they could reform without the U.S. Pretty strong threat, but you got to really wonder if they can pull that off. FOMC meeting is coming too this week, and inflation does look like it's firming a bit. It is now edging over the FOMC's target, and wage inflation is creeping back into the market too. It is very expected that the Fed will be raising rates this week at its meeting. Also, the ECB meeting coming up, and they're talking about ending QE this year. And Japan now readies its very long overdue policy change, as they have kept interest rates negative for seemingly forever, and they've kept themselves in a deflationary scenario, really a liquidity trap that's kept their economy from really being able to come out of the depths of deflation that they've been in for this long period of time. So that policy change is likely coming, and all of that is essentially a tightening around the whole world as they try the whole industrialized world now, talking about draining, or you might call it normalizing, as interest rates come back up to some level that, well, then they could lower them again. There is, of course, the picture of what was global stimulation and how the markets benefited from all of that money printing over basically almost a whole decade here, as far as the U.S. and ECB joining into what Japan had been doing for a couple of decades before. So that picture of global money printing actually is pretty interesting when you look back all the way through, well, around 2001, when Greenspan really started to set the trend about activist FOMC central banks around the world. And here you could see that picture right there. Very interesting as you see that what that looks at, and thanks to Hoop Trades for this chart. This looks through the end of 2017, where you can see 2001 to 2017, the amount of money printing. So these lines look pretty similar in color, but this is the total stimulus in billions in here, and you could see a huge amount of stimulus coming in from the central banks during this whole period. There was a brief period, of course, where they wasn't stimulating, and that was right in here, 2006-07, and of course that brought the big break in the markets. And you could see that right in here as the Dow lost half its value or more. And then, of course, when they started stimulating again in the Great Experiment, you can see what happened. The huge amount of money printed and the absolute huge move that we have seen in the S&P 500 during that time. So very interesting picture, and you can see that basically the world growth, which has been really very sluggish, very slow relative to other periods where there was a lot of recovery after recessions. Well, this one didn't have that much recovery. The money is basically gone into equity prices. And if that is the picture of money coming into the system, other than that period where they drained, if money going in and all the printing lifts stocks, then shouldn't the period where they stop that and they start draining, normalizing, selling off money from their balance sheets, selling off holdings from their balance sheets, shouldn't that be draining? Well, historically, what we have seen is that money drain equal bulls pain, and that's likely what's coming. Trade war, well, that actually could be good for the bond market. But of course, if the stock market started to coming down, the bond market would move up. So that's kind of what we have right in here as the source of funds that have driven the stock market up. Well, maybe when the source of funds of repatriation goes away, not sure how much longer that would last. But what it says to me is that the upside potential for the stock market is changing, and that the risk-reward ratio certainly seems to me that the amount of money that the stock market can go up, the amount of percentage that the stock market could go up versus the percentage that it could decline, well, I would say the risk-rewards sharply favor the downside. That is what I believe, or the situation is right now as we get into this period of monetary tightening. Let's take a look at what the stock market did at our 60-minute chart over this week, and you will see that, well, the elevation has continued as the market has continued to move up pretty much throughout the week. You could see end of the week, Thursday and Friday, it did start to stall. But what happened right in here is equities got a lift right in here, despite the fact that trade tensions were picking up there on Monday. But the stock market basically had this choppy day on Monday. Here, Mexico talked about retaliation on the tariffs. The peso had a big drop. The Mexican market is moving down very sharply. And we actually think that Mexican market is within a week or two of making a bottom. Netflix, Twitter, they came out as added to the S&P 500 on Tuesday. That gave this overnight lift to the indexes that you saw right there. But then the market got a little bit choppy, and a strong close is, well, pretty typical. On Wednesday, ECB hints at the end of QE to this year. You got U.S. labor costs rising, and bonds fell 1 point on that. It knocked these indexes down right over here. But then you could see Tesla, which exploded here for almost 10% on Wednesday, drove the NASDAQ, and Boeing jumps 11 points and drives the Dow up over 300. So you had this big move over here on Wednesday, really strong. Thursday is when the FANG started to get weaker. Those tech stocks started to weigh in the NASDAQ. The NASDAQ had a pretty good decline throughout the day, and the short covering came in right over here and saved the market from a big decline. And then the war of words started with this pre-G7 meeting right here, and the markets in Europe got knocked down. They came back some, and the Asian markets were hit pretty good. And then Apple came out, and they warned that to their suppliers that iPhone orders were soft, and the suppliers got hit, and that's where you got this drop over here overnight on Friday. But then from that point right there all the way through where we are right now with 2 hours left to go in the day, the market has pretty much firmed up and gotten right back up to the highs for the week. So you can see that, we've been in this basic uptrend, and this has been going on now for several weeks, that you can see without, well, anything but just a little bit of a choppy rest right over here at the end of the week. So that's a picture of the E-mini S&P on a 60-minute chart. Stocks for the week, major indexes up strongly between 1 and 2.5%. The Dow, the best mover, up about 2.5%. Catching up as it was the biggest laggard of all of the indexes. Bond market, 30-year down about 0.5 point. 10-year yields up 3 basis points to 2.93. Dollar down about 0.6% as we were looking for the dollar to start to pull back and for gold to start to move up. Well, gold not really making the move yet, only up about $4 on the week. Silver is the one that's stronger. That's up about 2% on the week, gaining about 36 cents. And oil pretty much flat on the week. It dropped early in the week, as we had anticipated, and then rebounded. Got a little bit lower than the levels that we were looking for, and is now trading in the week right about at the end of the week, right about 65.5. So it's been a soft period for the oil market. That is the opening segment for the week, and we are going to be right back with our best and worst stocks for the week. All right, for the best stocks of the week, what we always do is bring you our charts. Our charts are the core of our work is cycle analysis, and it is done on weekly charts to start, and then we bring it down to daily charts, especially in the 80 of the best traded symbols that we really focus on. We do analysis on 400 symbols, and for our subscribers, level 3 and 4, we share the core of that work on our charts every single week. So we're going to start out by looking at the best stock and the best group for the week. This is a returning group, as last week the retails were pretty mixed. Best and worst stocks for the week were in that retail group. This week the best group is retail, and I'm going to share with you 5 stocks that all had pretty nice gains for the week. The biggest gainer for the week is Abercrombie. I'm going to use this chart to do a little cycle analysis teaching right now, as you see that right over here. So cycle analysis is the a way of measuring and understanding the rhythms of the market. You could essentially call it the heartbeat. These are cycle brackets down over here, which give us a sense for the rhythms. In other words, when a stock is rallying, that's the rising phase, and it declines, well, through the declining phase. And when it looks like this, it's what we call a weak left-hand translation with a negative configuration that says it's probably still in trouble for lower lows. Here you could see higher highs and a good strong configuration, and the same thing right over here. When Abercrombie reported earnings last week, it had a big break, and we said that based on this timing, we thought it would reverse back to the upside. Well, you can see that exactly as you got that kind of a pattern. So lots of great stuff that you could see in here. This engulfing said it's likely a cycle peak, and that was. There was another engulfing pattern here. It gets down to the 34-week moving average right at the bottom of the intermediate support zone, and then has this big bounce. So up 15% on the week, and that big rebound after earnings. Now, we actually think there's some damage done in here, and you could see by our projection, we think it's going to continue up some, but then overall it's going to end up rolling over again, and this ultimately will end up to be a big top in Abercrombie. In the meantime, it traded pretty much exactly as we expected. Kohl's is the next one we're going to look at. This one, another one that just shows you the beautiful rounding bottom and cycle patterns in the bottom here, where it had this saucer pattern right in here. Here's your bullishly configured cycle, and then another one right here. It says that this high is likely to get taken out, and it was in this rising phase. So beautiful. Gets up to that 61.8% fib extension. The target really could be up here around $82, and there's a little bit more time to rally. The problem is it's very overbought. Analysts upgraded this stock, raised their targets on it, 12% gain on the week, but we measure overbought, oversold in the weekly chart by the distance from the 34-week moving average. You could call it the disparity between the 34-week moving average and the actual price. When it gets far away, as you could see right over here, it pulls back down towards it. Look at at all the times it crosses the 34-week moving average, and look at now the big distance. You cannot be a long side buyer for investment when you're under this condition. It's likely to roll over and give you a correction, and that would be down into the August time frame right over here when that peak comes. There is no sign for a peak. Overbought, tough spot. Can't buy it here, but it's done really well. Here is Macy's right over here, a very similar story. Now you could see in our projections in here, we're looking for a pullback and then a rally and then another pullback. Where does that come from? Well, it comes from right in here. There's your rally, there's your pullback in the minor cycle. Here's your next rally and then your next pullback. That's what you see right over here. You could see that happened in here, and it was in a upwards slanting move right there. This one could be the same way. The secondary high could be a little bit higher and then move down. So this decline right over here we're looking for is just a 2 or 3 week pullback in there, because again it is very far away from that 34-week moving average and very likely going to have some pullback in there. But overall, it's been a very strong stock, as has Dillard's. Look at that. Same story in here. No news. Weekly, very overbought. And we're going to look for some correction in there as it's just gotten nutty. I don't know what they could think about these big box retailers. Dillard's, Kohl's, Macy's, Abercrombie. They're all, subject to getting annihilated by not catching up on online sales. This looks to us, this whole group, like it's just fund managers chasing the group, and we don't like when you get this far away from those moving averages. There's just too much risk in there. Here is Under Armour. Now this is a stock that we were screaming about, this support zone and the low coming in, and then the next move as it broke above that neckline and the head and shoulders measurement, take it right up here to near 25 or just over 25. Well, it got up close to 25. Spectacular. Now, we expect that this will roll over also and go into a corrective phase. The retailers all look like they're going to correct into early August there, so once they make their tops, we would expect them to roll over. So Under Armour, a fantastic pattern, great performer in there, and now getting up near that measurement in the time where we would expect it to start to struggle. Bed Bath & Beyond up 9% on the week. That is still a very bad pattern. It gets up off of its butt, but Bed Bath & Beyond up to some resistance, 9% gain on the week. Urban Outfitters also way overbought, and we would expect that it would start to move down also. That gains about 7% on the week. Got a couple more stocks to talk about in the best of the week. First one we're going to look at is Twitter. TWTR. As we look at just a fantastic looking chart in here, we were bullish on it all the way. We got, I admit, got a little bit nervous about it after that Facebook data breach, and it had this big break, but then it really firmed again. And each time you get a positive cycle pattern, like right in here, you could see that it bottomed way above where it started. Then you expect that it's going to break above each high like it did right over here. There was your resistance, cycle peak resistance breakout, and then exploded up into the fib target zone. Fib target zone, that's the 100% fib extension, the 78.6% fib extension. That's often where we expect bullish stocks to get, and it's gotten into there. So we're going to be looking in here for it to run out of gas on the upside for a brief period of time, pull back into this area of about, we'll call it 38. That would be our screaming buy area in that support area, and then looking for higher prices again. Analysts are really happy about the change in their improved model, and that is something that we have expected all along. You can see the daily chart right over here on the right as it has been explosive, and one reason I want to put that up is so you could see the point that the slim ribbon turned positive and gave us daily momentum that was positive was right over here. The stock was $32. It rallies all the way up to 41 based on this positive momentum right there. So key to being on the right side of moves is understanding momentum positive in here also on this chart. So that is a great looking look at cycle patterns and, well, why a stock has a big move like that. Last one we're going to look at in the best of the week, and the biggest mover, but not in our opinion one of the best, is TSLA, Tesla. Tesla gets a big upside move. Now, this is a busy chart, isn't it? Lots of stuff in there. You could see two large harmonic cycle families. And then you can see our objective or projection over here of the stock going to sub 220 out in this September-October period. Well, there's a few things you can see in here. First of all, you can see that it's developed a downtrend. You see this cycle right in here? That's this one. Note that it closed lower than it started. That said that you were likely giving up this upward momentum and getting into downward momentum. And you could see this channel right over here as it rallies and then makes a lower low and then rallies and now gets up to that resistance level. And now we believe it's going to do one of these and do a big header on the downside. Lots of stuff came out. Musk got retained on a vote that was positive. He came out and said that production will soon be at 5,000 cars per week, the Model 3s. And then an analyst came out today and said, and that's why the stock is up, that their margins were going to improve as they got closer to those 5,000 cars, which makes it more cost effective. It makes sense. It's not really a brilliant statement that he made. And the truth is that if you look at what other analysts have reported this week about Tesla, that they are in a heavy cash burn condition. They're going to need to raise more money. It's extremely likely that they will. And then, of course, you got the problem of the high competition in the category, and the fact that you and I are paying for people to buy those cars through subsidies. That's going to be going away. So if you want to get, you know, the Model 3 with all the stuff in it that you really want when you own a Tesla, it's going to be $55,000 to $60,000. So forget that $35,000 strip-o car. It's not such a great deal, and I believe that the rose is off on this company, and we're going to start to see some pretty good downside on it again. Analysts have 450 as their upside target on the stock. I have 220 as my target on the stock, so see who's right. I'm betting on me. That is the best of the week. Wow. And in a moment, I'm going to bring you the worst, which has some, well, ugliness in it. All right, this is the worst of the week, and I'm going to show you solar stocks. I'm going to make a little bit of a statement in here as I switch over to First Solar that when you start to play around with free markets, you start to have the possibility of destroying stocks that or companies that, you know, have access to specific markets that are no longer going to have easy access anymore. These charts that we're going to look at here could be a prelude to what would happen in a real trade war, which there's at least there's a little smoke right now going on, whether or not we're going to be in a trade war or not. But this is what happens when you begin to inhibit companies access to markets. President Trump's tariffs on solar panels, and look at this stock, First Solar. This was a great looking stock, and you know, again, we're going to talk about cycle analysis. Positive cycle, you see that right in here. It bottomed where it should have, right somewhere right close there. It rallies up to a new high and then pulls back. Beautiful positive configuration, and then goes to a new high again, as it's supposed to. A great big top right there is that engulfs or gives you that big evening star, and then that was a big warning, and then the stock breaks that 34-week moving average you can see right there. And note the 34-week moving average, the resistance right over here. Now that's was a bit of a warning that you can see right there. Of course, momentum turned negative right up over here at about $72 or so. And where is it now? Well, it's at $52. And this is a total destruction. We tweeted this one out last week and said our target was somewhere around over here, possibly going to 46. It sure looks like it's going to 46, doesn't it? So look what happens in the corrective periods or declining phases. Here's a declining phase. Here's a declining phase. This was not a bad one, you see, because it was such a bullish market. Here's a declining phase, and here's a declining phase that ends in late June, beginning of July. This stock looks totally sick and totally destroyed well, I just told you why. Take a look at CSIQ. This was a stock I had thought had great value. It's been one of my favorites. Do you need anything clearer than that shows you in here as the market screamed that it was topping? Really? Look, here's the left shoulder, head, and right shoulder right in here. The right shoulder fails right in the resistance area, and look at this week as this tariff situation destroys the stock down to the 78.6%. You could see the uptrend right in here as each of these cycles trades within this uptrend. You can see that, and then the big right in here head that formed and the lower low, and then it fails, big down, ugliness, unbelievable. It signaled that it was coming, and that is really showing you the problem in there. Do I have anything here on the daily? Nope, I don't. I was going to see if I had something there to show you, but I don't have that updated. So this is the real picture of a stock that has been wrecked. And SunPower, SPWR, this is the one that hasn't quite wrecked itself yet, but you could see it's about to in this yellow zone. Corrective zones in our, when we have our phasing in here, are yellow. And when you break underneath a significant low right over there early in a cycle, it turns red, and then you have a major decline. So this one, you can see right here, it's pretty likely going to get below that last, see the multiple cycle lows right over there that are at little over 6. It very likely is going to break it. This is an ugly pattern there in SunPower, and you got to say, wow. If you start to inhibit trade on some of these bigger stocks, we're going to see indexes lose ground very quickly. And this may be just a little picture of that potential. Better hope that we get through this G7 meeting and we don't start seeing more tariffs come, or a battle with China where we actually impose 50 billion in tariffs on them. All of that stuff, well, maybe it makes for free trade, but is that what we want? Do we want to inhibit trade and see when this happens? You can see where I am. I'm a free trader. All right, so now let's take a look, and I'm sure I'm going to get some thumbs down for saying that. I had like 8 of them last week because I said things that were similar. So let's take a look now at the next stock, which is a Petrobras. I reported on this one last week, PBR, and said that the stock was moving down because they in Brazil had a strike going on, and Petrobras had to lower diesel prices by 10%, which really would greatly affect their earnings and margins, and the stock moves down another 9% this week. This is an example of a stock that's in a lot of trouble. And I said that last week, I'm going to say it again. Once you break that cycle low as early as you did, then you decline through this longer period of time right over here, and that's why the stock is still under pressure. If it picks its head up, you got to sell it because it's really looking like it's in a lot of trouble. The next thing we're going to look at is WYN, W-Y-N. And when we were looking for a pullback, it's in that big yellow zone. Why is it in a big yellow zone? Well, because of this big break when Steve Wynn had his issues put the stock down to that same low area right over there. And that's a warning to us that it's likely to roll over again. Well, you could see it actually put on a couple of months of upside movement in there, but then it got caught in this downward corrective period, and that's what's going on. So support in here right around that 34-week moving average around 172. Yeah, it's only got a week or two to go. It sure looks like it's coming to a buy area. Macau last week reported a 12% gain in revenues. I think the news is going to turn good for this stock again, and you're going to see some upside moves. So in the worst of the week is a stock I like. Deutsche Bank has lowered its target on this stock, but I think it's going to pick its head up, and that's what really helped push the market, push this stock down. We've seen the oil stocks pretty firm as oil prices moved up to $73, but then oil all of a sudden fell to near 64, and we've seen some of these oil stocks give ground. The ones that held up really well were the refiners. Now they're giving some signs in here that they're ready to at least have some profit taking. All three of the refiners that we look at, the ones that are pure refiners, they all were down about 3.5–4% on the week. And that is giving some signs of, well, maybe this is the spot for them to have some corrections. So only down 3.5–4% on the week. Still, we'll take a look at this and say there is a sign in here. You could see that it gets up and hits the fib target zone. Against the target zones are that 100% fib extension and the 78.6% fib extension. Gets up there, makes a double top, and then starts to roll over. See the support zone right over here? We would project that it would get down into that zone and then try the upside again. So this is around 75 on MPC. That's Marathon Petroleum. We would expect that it would get into there and then get a bounce. So we would consider this a buy zone. Note the 34-week moving average coming up into that zone also. You could see what it did right here and right over here. So if it got down to 75, I think that, well, short-term swing traders, that's people that hold for a few weeks. That would be a perfect entry area, wouldn't it, when you look at that? ANDV, that's the old Tesoro, ANDV, is a stock that looks to us like it's a similar situation. You could see that topping in there on the dark cloud cover, a pullback for a few weeks likely, around 136. That's about 9 points more from where it is right now. And then again, you'd be in the spot where we think it's going to bounce and then try the upside again. So we're looking for a little correction in there. And here is Valero. You could see that. Note the dark cloud cover right over there. Here's the support zone. This is a little different pattern because you'll notice it has these the harmonic families in there. In other words, it's a dominant and a minor cycle. So this is right in here is the one we're looking at. And then another rally, that's right in here. Pulls down for a couple of weeks. It would be nice to see it around that 115, 114 area and then catch the next rally right there before it then rolls over again. Look at these extensions, 261.8, 161.8. Those are from longer term patterns. And it's amazing that it got up there. Note how far it is away from that 34-week moving average. So we're looking for the a convergence. You know what an MACD is? A convergence of the price and the moving average to come somewhere right in there at some point. But we'll look for this right now is what we're looking for as we see in the entire group. Last stock we're going to look at here in the worst of the week, Western Digital. This one down about 4% on the week. Interesting that it got an upgrade as Cowen raised the target on the stock, WDC. I actually think that this stock is a stock that could be in some trouble, and I'll show you why. So take a look here. Of course, we've seen, the techs, all of them moving up to highs and, very strong market conditions in here. And look at this stock. It had a pretty good sized break. This is in the hardware storage category as it came from this area around 107 and breaks all the way down here to about 77. You see that? So that's this cycle right in here. You can see it gave up the whole move right there. When it does that, the next rally is often very deficient and then it breaks down under that low. So we actually think that this looks like it's going to move move back down over here pretty soon and probably break those lows right over there. This is really bad when you consider that Cowen upgrades the stock and then it fails after that. We included this in our list of stocks that we published to our members on Thursday, of stocks that we think are in a lot of risk. We showed 4 groups that we thought had a lot of stocks that could be moving to the downside pretty soon. We also showed 4 groups that once the market has a correction, we're looking for over this next several weeks, that we will then think that those 4 groups would be the most buyable, the ones that have the most likely upside in them as fund managers rotate into those groups. You're going to want to watch that video if you want to see that group and see more of our analysis. By the way, follow us on Twitter at askSlim, and also subscribe to our YouTube channel. Give me a thumbs up if you like what you've seen here, and if you don't, give me a thumbs down. Tell me why. Put a comment on there. And we actually had somebody do that this week, which really helps me. Rather than just telling me you hate what I'm doing, tell me why. Maybe I can get better at it. So we always want to know that. And also, if you like this cycle analysis that I'm showing you, you can take our cycle analysis workshop. Just go to our website, go to the top of that page, and you will see where it says workshops, and you can sign up for our amazing 20 video module cycle analysis workshop. It's incredibly comprehensive. You're going to learn a ton. I have people watching the whole 20 modules already on their 3rd or 4th time through it. So just absolutely great stuff. So make sure that you do watch that, and you will then be able to learn a ton. That's it for the best and worst, and I'm going to be right back with our short-term view for the coming week. All right, short-term view for the coming week, just as I do every single week, taking an accounting of how I did in the previous week. And before I do that, of course, I want to invite you to become an askSlim member. There are lots of ways for you to do that. If you're interested just in getting our stock market report on the indexes, it's hugely comprehensive. We put it out on Thursdays. You get to see all of our analysis, all of our charts, and interpretation of them all. It's just a great report called the Stock Index Report. We also update it with changes of momentum and trend along the way. So you can basically see all of our work on the indexes for $19 a month. Just absolutely incredible. And that is included in all of our premium memberships. You can try our level 2, all of our videos, over 300 videos that you will just learn a ton from, 8 different categories of videos. I'll send you a link for that for half price. You'll be able to watch all of that for just a whole month, unlimited watching. You're done, then just cancel, but it's just $18.50 for that half price link. I can also give you our rankings and setups, or our level 4, all of our charts, and everything else on the Thinkorswim platform. All of that analysis we do, plus our rankings and setups, videos, stock index report. I'll send you a half-price link for that. But you've got to be using our preferred broker, TD Ameritrade Thinkorswim platform, in order to get that. So there's so much that you can have. Our content is just unbelievably comprehensive, and you will continue to learn a ton. Yeah, I'm wrong sometimes, but that's what an analyst does, right? But it's a greater percentage of the time that the analysis is right, and our educational stuff that we bring you is just an amazing value. So do write me, slim@askSlim.com, for our half-price links, and subscribe if you don't want to get any of those half-price links, just to the stock index report for $19. It's just loaded with great information. All right, so now we're going to switch over to the daily charts as we look at our short-term view and look at the 5 different major markets that I always do. As far as how did I do last week, I was around 50 or 55%. It wasn't that good of a week. Of course, the stock market was much stronger than I gave it credit for, as it has really elongated the advance that we're looking for. So that one we really got wrong. Gold market, well, silver market we got right, but the gold market didn't start to move up yet, so we only get a little tiny bit of credit for that. As far as the dollar, we get about half credit for that, but we were really good as far as light crude and the bond market goes. So about 50% on the week, and we're going to do better in the coming week. So let's start out with light crude, and we're going to look at a 2-year daily chart and then bring it in so that you could get a sense for a little bit longer term cycle analysis that we're doing in here and what we are looking for. So what we said last week in light crude is that we expected that it was going to come down a little bit and then curl up right in here. That's exactly what it did. So we expected it to get down to about 65.5. It got down to about 64.20. So it was pretty much weaker than we had expected. Still, it followed the pattern and it followed the direction as we expected. Where did that come from? Well, it came from the short-term patterns right in here that you can see. And that was like right over here. You could see that, and that's like right over here. You can see that. Those are the 3 points where we had those nested bottoms in the third short of the 3 cycles. So that was, pretty clear to us, and it worked really well. Now where we are is we're in a spot where it should bounce, right? Where we should get an upside move. So you can see that right in here, we had big velocity on the upside right there. Right over here, we're turning up. We have no velocity on the upside. That's a little bit of a warning, and we're going to look for it to get up, though, over this next week. We're going to call it a small up week. The target is right up over here. That's around 67.48. is what we're looking for. So it's about a $1.70 bounce in there, and then we think it's going to roll over from there. So we think we'll get a good bounce. It'll then come back down. We'll get another rally in here as we get into like this type of a rising phase, but we have some doubts about it being strong and really getting very far. The reason is because the intermediate patterns are warning us about correction. And we really encourage you to watch our Future Speak video as we talk about those longer trends, and then you get to see all of our analysis. We do that every single Wednesday, and we go over the intermediate and weekly patterns, and that is where you get the sense for what will be driving these shorter term patterns. So right now we're looking for a rally. We're going to call it an upside week, but not very big, and not be able to hold or get past that the bottom of that resistance zone is what we're really looking at right there. So that is light crude. Next thing we're going to look at is the dollar and the euro. So here is that pattern right in here. So what we thought for the dollar last week is that it would be a small week. It would try to rally and then fail. Now, that's basically what happened. You could see the rally right in here that failed and then came back down. The reason we said that was because, well, we were in this period of decline, but it was oversold. You could see that. It's still oversold. It has not been able to pick up its head, so there's a lot of pressure on the dollar right now. We're expecting this rally. In other words, you get a little bit of a rally for a few days, maybe only 2 days, and then turn over much harder over here. So this period out towards the end of June is where we expect it to decline sharper into that area. So just a modest attempt at an uptick, and maybe a small change on the week as we get this downtrend in here fighting this uptrend in here, and that's going to kind of give you this range right in here temporarily, and then it will likely roll over in a much harder way. So we'll just call it, kind of a small change there. The inverse of that, if you trade the euro as the proxy, is this, where we see this little the resistance zone there and this flag that's being formed, it's a little difficult to see. Let me remove this part of it anyway. And so what we expect is a little breakdown from this flag and then moving up again, opposite of what we see in the dollar. So if we get a little bit of a dip, we think it'll dip and then go right back up. So again, we're looking for a small change in the euro currency. And this is probably not the week we're going to get big moves in there based on what we're seeing right now. Momentum remains negative, as you could see right in here. As you look at the euro, as far as momentum in the dollar goes, DXY, I'm going to go back to there right now. You can see in here that momentum is just, see this in the just rolling over right over here. It's about to lose its upward momentum that it's had for all of this time in here when it moved up from 91 all the way up here to 95. So there's a risk that this momentum, upward momentum, is disappearing, and it makes sense that it would be. Momentum conditions probably changing here in the dollar. Here is the gold market right in here, I promise you. And that right there looks like a trap. You see it's trapped in there, and we had expected gold to be able to rally up to this level right over here, 315 to 325, and it was just stuck. I mean, gold hardly had a move the whole week long, whereas silver did what we expected. I'm going to show you that silver chart right in here, /SI. And that one did, well, what we expected. You see it pops up way into that resistance zone. And so silver is leading the way in here. That gives us some sense that gold is likely to follow. And go back to that gold chart. So again, we're looking for a similar occurrence, for it to pop up into this area of resistance. Then maybe not, it's not quite ready for the big upside move in there yet, and still get into some range-bound trading in here. But overall, we'd say the odds of the upside move breaking out of this rectangle are higher than the odds of a breakdown in here. And we see the other metals kind of showing us that. Copper got much, much stronger. So we expect gold to have a choppy but upside week, which is pretty much the same as we said last week. In here, and momentum in here has been negative, and you can see in here that the momentum is just trying to get better. The silver momentum has turned positive right now as it hit our upside targets. Next thing we're going to look at is the bond market, /ZB. We said last week to 2 to 3 day dip and then moving to the upside. Well, there you go. There's your 2 to 3 day dip, perfectly following the patterns that we're looking at in here. You can see, you see this pattern right here, and this one right here, and this one right over here. So essentially what I want to do is I want to darken those so that you can see them a little bit better. And there's that pattern right there. So you can see how just magnificently it follows those cycle rhythms. Those are the minor ones. And here was the downtrend. You see that right in there? Perfect. And here's where it makes this bottom. We're looking at this upside move. This light one is not in play anymore right now. And that gives us this rally right here, and then the decline. And then this is the buy zone right there, which we told our subscribers just in the last couple days that, you know, pay attention to this because this looks like a favorable long side spot. Sure enough, you could see the pop coming up in there, and we still think it's going to be an upside week. We're looking for a test of that high up around 146 area. And for it to do that, we're probably going to need to see weakness in the stock market for that to happen. So that is a look at a short-term pattern that is very, very consistent. So the stock market, we said last week that we thought in the next couple of weeks we were going to start to see a decline that would be dropping 100 to 125 points in the S&P 500. Then on Wednesday, on Future Speak, we showed our subscribers that that time period had shifted out as the dominant patterns that were in the Russell and the NASDAQ had really taken a hold on the upside, which essentially shifts the whole pattern out about 14 days that we're looking at. So that's maybe to some an excuse or a poor explanation for why what I believed was going to happen is actually pushed out into late June and early July, which was the outside of our intermediate term window for a correction. So it's now looks to me like it's just going to be a little bit later. It doesn't change anything other than, again, we raise our objectives based on the time being shorter. And also, we think that the decline will be actually more brief based on the cycle patterns kind of collapsing in time-wise on us. So take a look here at the S&P 500. I think that those people that follow our cycles understand what I just said, and those people that really don't probably are saying, well, there's some hocus pocus there. But I do understand it, so that's all that matters to me. Take a look right over here at the S&P 500, and I'll show you now what I just said that will make some sense. This gray cycle right over here, that's what we thought was going to be the dominant pattern, and that this moving down right over here would bring you a large decline. That's what we've been talking about. Now, what happened was that this big cycle right over here is actually the Russell and the NASDAQ. They line up pretty nicely. And what that did is it shifted it out by 14 days right over here. That means that this rally that you see right over here, instead of being late and ready to move down, is actually a little bit more early. It gets up into this resistance zone, so this is what we're looking for this week. That's this decline right over here, but that's not the big one. The big one would come after some choppiness in here and then rolling out. You can see right in here that that projects the bottom of that corrective period, and now the high risk period for the NASDAQ and the Russell, which is the dominant indexes in here, those end in the middle of July. So that's essentially what we're looking for. We're going to look for a down week this week of some modest amount that gets us down into this support zone, then another rally over here, and then this period over here in late June to mid-July as the period of the greatest risk for a correction. So pull back this week, the target zone would be right over here around 27, this is 2740, this is 2730 roughly, and this is roughly 2717. So that's the zone we're looking at right in there for a minor pullback, between 2740 and 2717. And then the risks of those lower numbers down in these 2600s down over here comes in late June and into July. So we'll just call it a modest down week this week. These are two fib confluence areas right over there that you can see, and there's a little note to our subscribers that the Russell and the NASDAQ dominant cycles have shifted out to mid-July, and that would be this double confluence area right over there gives you where the resistances are right now, as we're stalling in one of them at the moment right now. If it gets through there, which would surprise me, but they keep surprising me, that would be 27.95 to about 27.98. So that's what we consider to be the extreme. If it got more legs on the upside before it started to correct, we actually doubt that. We think it's going to roll over. It will be a down week of some modest proportion, and then again after that, trying the upside again before we get into any significant corrective period. Yes, that is a slight change to what we were looking for, and when we get it wrong, we try to figure it out and try to figure out what to do from this point forward, because the analysis for what happened before is only good for learning something. The analysis for what's yet to come is what we're going to trade off of. So that's it. That's the market week for this week. I hope there was a lot of great information for you in there. And don't forget, I made a lot of offers in here. We really want you to become part of the askSlim family. And if it's the stock index report that brings you in, then for $19 a month, you're going to be shocked by how much information what we share. So that's some very interesting stuff that we're bringing you all along. And ask me, write me slim at askSlim.com for those half-price links, and you'll be able to try us out for a month at any of the levels and really get a good sense for what we do, if you're not a member already. That's it for Market Week for this week. I want you to be really careful because it is so crazy out there. And we're always wishing you great trading.